The window is closing. Not metaphorically, not eventually. Right now, as you're watching this, something fundamental is shifting in the precious metals market that most people won't understand until it's too late. And I'm not talking about some distant future scenario or theoretical possibility. I'm talking about a structural change happening in real time that's about to lock out retail investors from opportunities that institutions have been quietly positioning for. Let me show you what I mean. While everyone's been distracted by headlines and noise, central banks have been doing something they haven't done at this scale in decades. They've been accumulating gold at a pace that would make your head spin. We're not talking about modest additions to reserves. We're talking about systematic, aggressive buying that tells you everything you need to know about what's coming. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions on the planet, run by people who have access to information you and I will never see, and they're moving with urgency. Think about what that means for a second. When was the last time you saw central banks agree on anything? They can't agree on interest rate policy. They can't agree on inflation targets. They can't agree on currency interventions. But somehow, from Poland to China, from Singapore to Turkey, they're all doing the exact same thing with gold. That's not coincidence. That's coordination based on something they all see coming. Now here's where it gets interesting. The buying window that's been open for retail investors, the ability to acquire physical metal at anywhere near reasonable premiums, that window is starting to close. And I can prove it to you with what's happening right now in the physical market. Dealers are reporting something they haven't seen in years. Premiums are starting to spike, not because of panic buying from retail, but because of systematic removal of supply from the market by larger players. The metal is disappearing into strong hands, and it's not coming back out. You want to know what's really happening? Let me paint you a picture. There's a reason why the gold to silver ratio has been behaving the way it has. There's a reason why we're seeing divergence between paper prices and physical availability. There's a reason why delivery times are extending, and why certain products are suddenly harder to source. It's because the market structure itself is changing, and most people are going to wake up one morning and realize they missed their chance to position themselves before the shift became obvious to everyone. Before I go further, if you're someone who's been thinking about protecting your wealth but haven't taken action yet, I put together a free guide that breaks down exactly what thousands of American retirees are doing right now to safeguard their hard-earned savings. It's in the description below. No fluff, just the strategies that are actually working in this environment. Grab it while you're thinking about it, because what I'm about to show you is going to make it very clear why timing matters right now. Let's talk about what's actually driving this. The supply side of precious metals is facing constraints that most analysts aren't properly accounting for. Mining production isn't keeping pace with demand, and that's not a temporary situation. These are multi-year development cycles we're talking about. You can't just flip a switch and produce more gold or silver. The easy deposits have been mined, the ore grades are declining, the costs are rising, and the timeline from discovery to production keeps getting longer because of regulatory hurdles, environmental concerns, and the simple geological reality that the best deposits were found decades ago. Meanwhile, on the demand side, you've got forces converging that have never converged quite like this before. Industrial demand for silver is exploding because of the green energy transition. Every solar panel, every electric vehicle, every 5G infrastructure build-out requires silver. And we're not talking about modest amounts. We're talking about consumption that's growing exponentially while above-ground inventories are shrinking. The math doesn't work. There's not enough silver being produced to meet industrial demand, investment demand, and jewelry demand simultaneously. Something has to give. But here's what most people miss. The real story isn't just about supply and demand fundamentals, as compelling as those are. The real story is about what's happening in the monetary system itself. We're watching the slow motion unraveling of the post-1971 dollar standard, and precious metals are reasserting themselves as the ultimate form of money that no government can print and no central bank can debase. That's not conspiracy theory. That's just monetary history playing out the way it always has when fiat currencies are overextended. Look at what's happening with BRICS nations. They're not just talking about alternatives to the dollar. They're building the infrastructure for trade settlement outside the dollar system. And what's the one asset they all agree on as a neutral reserve? Gold. Not yuan, not rupees, not rubles, gold. because gold doesn't have counterparty risk. Gold can't be sanctioned. Gold can't be frozen in a foreign bank account. Gold is the ultimate settlement asset in a multipolar world. And we're transitioning to a multipolar world whether the West wants to admit it or not. Now let me tell you about something that happened that most people don't know about. Back when Nixon closed the gold window, there was a brief period where people could still exchange dollars for gold at the old rate if they moved fast enough. But that window closed quickly, and the people who hesitated paid a massive price in purchasing power over the following decade. We're in a similar moment right now, except the mechanism is different. The window that's closing isn't a government policy. It's a market structure shift where physical metal is being removed from public availability by entities that understand what's coming. Think about the mechanics of how this works. When central banks buy gold, they're not selling it back. When sovereign wealth funds accumulate silver, they're not trading in and out. When institutional investors take delivery of physical metal and put it in allocated storage, that metal is effectively removed from the available supply. It's not coming back to market at these price levels. And every ounce that moves from weak hands to strong hands is one less ounce available for the next person who wakes up and realizes they need to own some. The paper market, the futures market, the ETF market, these are all mechanisms that were designed to allow price discovery without requiring physical delivery. And they work great as long as everyone's content to trade paper claims. But what happens when a critical mass of market participants decides they want the actual metal? What happens when the ratio of paper claims to physical metal gets tested? We've seen glimpses of this during previous crises, but we've never seen it play out in an environment where central banks themselves are competing for physical supply. Here's something that should concern you. The COMEX, which is supposed to be the primary price discovery mechanism for gold and silver, has been showing some very interesting patterns in its delivery data. The amount of metal standing for delivery relative to open interest has been rising. That means more people are actually taking delivery instead of just rolling contracts forward. That's a sign that sophisticated players are using the futures market not for speculation, but for actual acquisition of physical metal. And when that happens, it puts stress on a system that was never designed to deliver significant percentages of its notional value. Let me give you a historical parallel that might help this make sense. In the late 1970s, there was a period where silver was trading at one price in the futures market and a completely different price in the physical market. The spread between paper and physical got so wide that it created arbitrage opportunities that should have been impossible in an efficient market. But they existed because the physical market was tight and the paper market was still pretending everything was fine. We're starting to see echoes of that dynamic again, except this time the scale is much larger and the implications are more profound. Now, I want to talk about something that doesn't get enough attention: the role of silver in all of this. Everyone focuses on gold because gold is the monetary metal, the reserve asset, the thing central banks hold. But silver is where the real supply squeeze is developing. Silver has this unique dual nature, where it's both a monetary metal and an industrial commodity. That means it faces demand from investors who want to preserve wealth and from industries that need it for production. And unlike gold, silver gets consumed. It gets used up in industrial applications where it's not economically recoverable. Think about what that means. Every year, a significant portion of silver production is permanently removed from the available supply because it's used in applications where it can't be recycled. Meanwhile, above-ground inventories that built up over decades are being drawn down. The silver that used to sit in government stockpiles, gone. The silver that used to be held by industrial users as buffer inventory, drawn down to minimal levels. The silver that used to be available in the retail market at modest premiums, increasingly difficult to source in size. And here's the kicker. The price of silver relative to gold is still near historic lows. The gold to silver ratio is telling you that silver is undervalued relative to gold by almost any historical measure. But more importantly, it's telling you that the market hasn't yet priced in the supply constraints that are developing. When that repricing happens, and it will happen because math is math and you can't consume more than you produce indefinitely, the move is going to be violent. Not gradual, not orderly, violent. Let me tell you about the psychology of what happens in these situations. Right now, most people are comfortable. They see precious metals prices at levels that seem high relative to recent history, and they think they've missed the move. They think they'll wait for a pullback. They think they have time. But here's what they don't understand. The big moves in precious metals don't happen gradually. They happen in surges that leave people behind. You get a period of consolidation where nothing seems to be happening, and then suddenly you get a move that takes prices up so fast that by the time people realize what's happening, they're chasing. And during those moves, something else happens that's even more important than price. Availability disappears, premiums explode, delivery times extend from weeks to months, dealers run out of inventory, mints can't keep up with demand, and people who thought they could just buy whenever they wanted discover that the metal isn't available at any reasonable price. That's what I mean by the window closing. It's not just about price, it's about access to physical metal before the crowd realizes what's happening. Now, if you're sitting on retirement accounts, if you've got wealth that's currently in traditional assets, you need to understand something. The system you've been told to trust, the system of stocks and bonds and dollar-denominated assets, that system is built on assumptions that are being tested right now. Assumptions about the stability of the currency, assumptions about the sustainability of government debt, assumptions about the ability of central banks to manage the economy without consequences. Those assumptions are being challenged, and precious metals are the insurance policy against those assumptions being wrong. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs actually work. It's in the description. It covers how you can get physical gold into your retirement account without triggering tax penalties, how the process works, what the rules are, and what you need to know to make an informed decision. It's worth checking out if you're in that situation, because what I'm describing isn't theoretical. This is about protecting wealth you've spent decades building. Anyway, back to what's happening in the market right now. The institutional players, the ones who move markets, they're not waiting. They're not debating whether precious metals make sense in a portfolio. They're accumulating, and they're doing it quietly, systematically, without creating headlines. You know how I know? Because the data shows it. Central bank purchases are at multi-decade highs. ETF holdings are being drawn down as investors take delivery of physical metal. Mint sales are strong despite prices being elevated. These are not the actions of a market that's topping. These are the actions of a market where smart money is positioning for something bigger. Let me give you another historical example that might resonate. In the early 2000s, gold was trading in the low hundreds. Most people thought it was a relic. Most financial advisors wouldn't touch it. Most institutions had zero allocation. But a small group of investors who understood monetary history and market cycles were accumulating. They weren't trying to time the bottom. They were building positions because they understood the fundamentals. And over the next decade, those people made generational wealth while everyone else was trying to figure out what happened. We're in a similar setup right now, except the fundamentals are even more compelling. The debt levels are higher, the currency debasement is more extreme, the geopolitical tensions are more severe, the supply constraints are tighter, and the awareness among institutional investors is much greater. This isn't a fringe idea anymore. This is mainstream institutional strategy. The difference is, most retail investors haven't figured it out yet. They're still operating on old assumptions about what makes sense in a portfolio. Here's what you need to understand about market structure. The precious metals market is tiny compared to other asset markets. The entire gold market is smaller than the market cap of a single large tech company. The silver market is even smaller. That means when capital starts flowing into these markets, the price impact is enormous. You don't need a huge percentage of global wealth to move into precious metals to create a massive price move. You just need a shift in perception, a recognition that maybe holding paper assets denominated in currencies that are being debased isn't the safest strategy. And that shift is happening. You can see it in the flows. You can see it in the positioning. You can see it in the way institutional investors are talking about precious metals now versus how they talked about them 5 years ago. The narrative has changed. It's no longer about whether you should own gold and silver. It's about how much you should own and in what form. That's a fundamental shift in market psychology, and it's the kind of shift that precedes major moves. Now let's talk about what happens next. The technical setup in both gold and silver is showing something interesting. We've had a period of consolidation after a strong move. That's healthy. That's normal. That's what markets do before the next leg higher. But what's different this time is the underlying bid. The market isn't giving back gains the way it used to. Support levels are holding. Dips are being bought. That tells you there's real demand underneath, not just speculative froth. The fundamental drivers are only getting stronger. Inflation isn't going away, no matter what the official numbers say. Anyone who buys groceries or pays rent or fills up their gas tank knows the real inflation rate is much higher than what's being reported. And precious metals are the classic inflation hedge, not because they go up in value, but because they maintain purchasing power while currencies lose it. That's the key distinction most people miss. You don't buy gold and silver to get rich. You buy them to stay rich, to preserve what you've already built. But here's where it gets really interesting. We're not just dealing with inflation. We're dealing with a potential restructuring of the entire global monetary system. The dollar's role as the world's reserve currency is being challenged in ways it hasn't been since Bretton Woods. That doesn't mean the dollar is going to collapse tomorrow, but it does mean the premium the dollar enjoys as the reserve currency, the ability of the US to run massive deficits without immediate consequences. That premium is eroding. And as it erodes, the appeal of assets that don't depend on any government's fiscal responsibility becomes more obvious. Think about what that means for someone planning for retirement. You've spent your whole life building wealth in a system denominated in dollars. Your 401k is in dollars. Your savings are in dollars. Your pension, if you're lucky enough to have one, is denominated in dollars. But what if the purchasing power of those dollars is systematically eroded over the next decade? What if the retirement you planned for costs twice as much in nominal terms because the currency has been debased? That's not a hypothetical. That's what happens in every fiat currency system eventually. The only question is timing. And the timing is looking increasingly urgent. The fiscal situation in most developed countries is unsustainable. The debt to GDP ratios are at levels that historically have led to either default or inflation. Default isn't politically feasible when you control the printing press. So that leaves inflation. Not the modest inflation that central banks target. The kind of inflation that erodes purchasing power fast enough to reduce the real value of debt. And if you're holding assets denominated in the currency being inflated, you're the one paying for that debt reduction. This is why central banks are buying gold. They understand this dynamic better than anyone. They know that when the system is under stress, when confidence in fiat currencies is tested, gold is the asset that maintains value. It's not about making a profit. It's about preserving wealth through a transition that's going to be painful for people who aren't prepared. And if central banks are preparing, if sovereign wealth funds are preparing, if institutional investors are preparing, what does that tell you about what you should be doing? Let me bring this back to something practical. The window I'm talking about isn't just about price. It's about the ability to acquire physical metal in size at reasonable premiums. Right now, you can still do that. You can still call a dealer and buy gold or silver and have it delivered in a reasonable time frame at premiums that, while elevated, aren't crazy. But that window is closing. As more people wake up to what's happening, as demand increases, as supply gets tighter, that ability goes away. And once it's gone, it doesn't come back until after the crisis has passed and prices have already made their move. I've seen this movie before. I saw it in 2008 when the financial crisis hit, and suddenly everyone wanted physical metal, and dealers couldn't keep inventory. I saw it in 2020 when COVID hit, and mints shut down, and premiums went through the roof. And I'm seeing the early signs of it happening again, except this time the underlying fundamentals are more severe, and the supply situation is tighter. The people who position themselves before the crowd realizes what's happening are the ones who get the metal at reasonable prices. Everyone else pays up or goes without. Here's something else to consider. The regulatory environment around precious metals could change. We've seen governments restrict gold ownership before. We've seen capital controls implemented. We've seen export restrictions on strategic metals. I'm not saying that's going to happen tomorrow, but I am saying that in a crisis, governments do things they wouldn't do in normal times. And if you wait until the crisis is obvious to everyone, you might find that your options are more limited than they are right now. The smart play, the play that sophisticated investors are making, is to build positions now while the window is open, not trying to time the exact bottom, not waiting for the perfect entry point, just systematically accumulating physical metal because the risk-reward is asymmetric. The downside is limited because these are real assets with intrinsic value and thousands of years of history as money. The upside is substantial because we're in the early stages of a move that could last years and take prices to levels that seem impossible right now. And let's talk about silver specifically for a moment, because silver is where the opportunity might be even more compelling. The supply-demand fundamentals in silver are tighter than gold. The industrial demand is growing faster. The above-ground inventories are smaller relative to annual production. And the price is still at levels where accumulation makes sense for anyone who understands the setup. When silver moves, it moves fast and it moves far. The volatility is higher than gold, but so is the potential return. For someone who can handle that volatility, who can think in terms of years rather than months, silver represents an opportunity that doesn't come along often. Now, I want to address something that people always bring up. They say, but I can't eat gold. I can't eat silver. Why would I want to own something that doesn't produce cash flow? And that's a fair question if you don't understand what precious metals are for. They're not for producing income. They're for preserving wealth. They're for having something that holds value when other assets don't. They're for having optionality in a world where the rules might change in ways we can't predict. Think of them as insurance, not as an investment. You don't buy insurance hoping to collect on it. You buy it so you're protected if something goes wrong. And right now, the probability of something going wrong is higher than most people realize. The system is more fragile than it appears. The debt levels are unsustainable. The political tensions are rising. The monetary experiments we've been running for the past decade have no historical precedent for ending well. I'm not saying the sky is falling tomorrow. I'm saying the risks are elevated, and the prudent thing to do is have some insurance. And precious metals are the best insurance against monetary chaos that exists. Let me give you one more historical parallel, and then I'll bring this home. In the 1970s, there was a period where inflation was running hot, confidence in the dollar was declining, and precious metals went on a run that made early investors wealthy. But here's what most people forget. The big gains didn't come in the first few years. They came in the final blow-off phase when everyone suddenly realized what was happening and rushed in all at once. The people who bought early and held through the volatility were the ones who captured the full move. The people who waited until it was obvious paid much higher prices and got much smaller returns. We're in the early stages of a similar setup. The fundamentals are in place. The institutional buying is happening. The supply constraints are developing. But the crowd hasn't figured it out yet. Most people are still comfortable in their traditional portfolios, still trusting that the system will work the way it always has, still believing that stocks and bonds and cash are sufficient. And maybe they're right. Maybe this time is different. Maybe the debt doesn't matter. Maybe the currency debasement doesn't matter. Maybe the geopolitical tensions don't matter. But what if they're wrong? What if this plays out the way monetary history suggests it will? Are you prepared for that scenario? That's what this comes down to. Not trying to predict the future with certainty, because nobody can do that, but recognizing that the risks are elevated and the prudent thing to do is have some protection. And precious metals are the protection that has worked for thousands of years, through every monetary crisis, through every currency collapse, through every period of inflation and instability. They're not perfect, nothing is, but they're the best option we have for preserving wealth when the system is under stress. So here's what I want you to take away from this. The window for acquiring physical precious metals at reasonable prices is closing. Not because of some conspiracy, not because of manipulation, but because of simple supply and demand dynamics playing out in a market where institutional buyers are competing for limited supply. The people who understand this are positioning themselves now. The people who don't are going to wake up one day and realize they missed their opportunity. Which group do you want to be in? If you've watched this far, you're clearly someone who takes this seriously. You're someone who's thinking about the future and how to protect what you've built. That's exactly who I created that guide for. It's in the description. And if you're an American retiree with at least $100,000 in retirement accounts, you also qualify for a free one-on-one educational web conference where we can walk through your specific situation and what makes sense for you. No obligation, no pressure. Just education and information so you can make the best decision for your circumstances. But you have to mention you watched this video to get access to that. The window is closing. The opportunity is now. The question is whether you're going to act while you still can, or whether you're going to look back in a year or two and wish you had. The choice is yours, but the clock is ticking.